Long before charts, models, or economic textbooks, one man noticed something most systems still pretend not to see. Wealth doesn't rise in a straight line. Power doesn't accumulate forever. And prosperity, left unchecked, carries the seeds of its own decline. This wasn't a theory built in a university. It was a pattern observed in the real world, written down by someone who had watched empires rise, peak, and rot from the inside. Welcome to the Financial Historian Files, where money, power, and history collide. And nothing is ever as simple as it looks. In the 14th century, while Europe was struggling through plagues, wars, and feudal fragmentation, a North African thinker quietly wrote what may be the most accurate description of economic cycles ever produced. His name was Ibn Khaldun. And centuries before Adam Smith, Keynes, or modern macroeconomics, he explained why economies expand, why states grow fat, and why they eventually collapse under their own weight. Ibn Khaldun was born in 1332 in what is now Tunisia, into a world that was anything but stable. Dynasties rose and fell quickly, cities prospered and emptied just as fast, plague moved through populations with brutal efficiency, power shifted constantly between rulers, tribes, and factions. This wasn't a calm environment for abstract theorizing, it was chaos. And that chaos became his laboratory. He wasn't an academic locked away from reality. He served courts, he advised rulers, he watched governments mismanage wealth, overtax their people, lose legitimacy, and then act surprised when everything unraveled. Over time, he began to notice something unsettling. The same story kept repeating. Different names, different religions, different locations, but the same arc. Discipline turned into comfort, comfort turned into decadence, decadence turned into decline. What Ibn Khaldun understood, and what makes him so relevant today, is that economic systems are not machines. They are social organisms. They depend on trust, cohesion, incentives, and shared belief. When those weaken, no amount of gold or authority can save the structure. At the center of his thinking was a concept he called asabaya. Translated loosely, it means social cohesion, the glue that holds groups together. But in economic terms, it's far more than cultural unity. It's trust, it's shared incentives. It's the willingness of people to cooperate, sacrifice, and invest in something larger than themselves. Ibn Khaldun observed that societies with strong cohesion were productive, resilient, and capable of building wealth even with limited resources. Groups that trusted each other worked harder, defended their institutions, and enforced norms that supported long-term stability. Wealth followed naturally, not because they were richer to begin with, but because their structure allowed productivity to flourish. Over time, success changed behavior. As wealth accumulated, elites grew distant from the productive base that created it. Rulers became insulated. Bureaucracies expanded. Military and administrative positions became inherited rather than earned. The discipline that built the system softened. Comfort replaced necessity, and cohesion weakened. This wasn't a moral judgment. Ibn Khaldun wasn't scolding societies for becoming lazy. He was describing incentives. When survival is no longer urgent, behavior changes. Risk tolerance drops, innovation slows, extraction becomes easier than creation. The state begins to live off its past success rather than present productivity. Nowhere is this clearer than in his analysis of taxation. Ibn Khaldun noticed that early in a state's life, taxes were low. People worked, traded, and invested willingly because the rewards outweighed the burden. Economic activity expanded. Revenue grew. As the state matured, rulers increased taxes to support growing courts, armies, and administrative layers. At first, revenue still rose, but eventually, higher taxes discouraged production. People worked less, trade shrank, the tax base eroded. The response was predictable. To maintain revenue, taxes were raised again and again. Each increase accelerated the decline. The state wasn't starving because it taxed too little. It was starving because it taxed too much of a shrinking economy. In modern terms, Ibn Khaldun described diminishing returns centuries before the phrase existed. What makes this insight so powerful is its neutrality. He didn't argue that low taxes were virtuous or high taxes evil. He argued that incentives matter. When people believe effort will be punished rather than rewarded, they disengage. When capital is extracted faster than it can regenerate, the system weakens. States don't collapse because they lack authority. They collapse because they exhaust the source of their own strength. Ibn Khaldun extended this logic to government spending and corruption. As states aged, he observed, rulers grew accustomed to luxury. Court life expanded. Public funds were diverted to preserve status rather than productivity. Bureaucracies multiplied. Positions were sold or inherited. Corruption didn't begin as criminal intent. It began as normalization. Everyone adjusted to the new standard. The system didn't feel broken. It felt entitled. And that entitlement had consequences. Spending rose faster than output. To compensate, taxation increased. To enforce compliance, coercion expanded. Trust eroded. As cohesion weakened, Enforcement became more expensive and less effective. The state spent more to get less, trapped in a cycle of its own making. What's remarkable is how modern this sounds. Replace dynasties with institutions, replace courtiers with bureaucracies, replace caravans with supply chains. The logic remains intact. Ibn Khaldun wasn't describing medieval peculiarities. He was describing universal behavior under power and prosperity. Perhaps his most important contribution is this: markets reflect people before they reflect numbers. Prices move because confidence moves. Productivity rises because incentives align. Decline begins not with collapse, but with subtle shifts in behavior. Less trust, more extraction, weaker cohesion. Ibn Khaldun didn't believe cycles could be prevented. He believed they could be understood. Awareness didn't stop decline, but it removed illusion. It replaced surprise with clarity. And clarity, in his view, was the closest thing to control humans ever get. If Ibn Khaldun were alive today, he wouldn't be impressed by our technology. He wouldn't be distracted by the speed of markets, the complexity of financial instruments, or the sophistication of economic language. He would look past the screens and spreadsheets and focus on what he always focused on: incentives, cohesion, and power. And what he would see would feel painfully familiar. Modern economies like to believe they've escaped history. We talk about progress as if it's linear, permanent, and cumulative. Each generation assumes it has finally solved the problem of instability. Better data, better policy, better institutions. But Ibn Khaldun's core insight cuts through all of that optimism. The cycle doesn't disappear when systems become more advanced. It accelerates. In today's world, asabiya still exists. It's just harder to see. Social cohesion now shows up as trust in institutions, confidence in currencies, belief in rules, and willingness to cooperate within large impersonal systems. When those elements are strong, economies grow. People invest. Risk feels manageable. Long-term planning makes sense. When they weaken, everything becomes transactional. Short-term thinking dominates. Extraction replaces contribution. You can see this clearly in boom periods. Early in an expansion, growth feels productive. New businesses form. Innovation spreads. Returns are tied to real output. Over time, success changes behavior. Capital concentrates. Barriers rise. Financial engineering begins to outperform real production. Wealth becomes less about creating value and more about positioning within the system. This is the modern version of Ibn Khaldun's elites, drifting away from the productive base. Governments face the same pressures he described centuries ago. As economies grow, states expand alongside them. Programs multiply, administrative layers thicken, expectations rise. None of this is inherently malicious. It's structural. Prosperity creates demands that only prosperity can temporarily sustain. But when growth slows, the commitments remain. Revenue becomes harder to generate. The temptation to extract intensifies. This is where taxation, debt, and monetary policy intersect. Modern states don't rely solely on taxes anymore. They borrow, they inflate, they defer costs into the future. But the logic Ibn Khaldun identified still applies. When the burden of maintaining the system begins to outweigh the perceived benefits of participation, cohesion erodes. People disengage economically, politically, or psychologically. Trust weakens. Compliance becomes fragile. Debt in this sense functions like delayed taxation. It allows states to preserve living standards and institutional scale without immediately confronting declining productivity. For a while, it works. Confidence holds. Markets absorb issuance. Growth appears stable. But the underlying dynamic hasn't changed. The system is still consuming future output to support present structures. Eventually, the arithmetic becomes unavoidable. Ibn Khaldun would recognize this moment instantly. It's the phase where complexity outpaces coordination, where maintaining appearances becomes more important than maintaining foundations, where leaders mistake temporary stability for permanent strength. This isn't collapse, it's pre-collapse, the stage where systems feel most confident and most vulnerable at the same time. What makes this cycle so persistent is that it doesn't rely on bad intentions. It relies on normal behavior under success. Individuals respond to incentives, institutions protect themselves, elites rationalize extraction. Each step feels justified in isolation. It's only when viewed as a whole that the pattern becomes obvious. Modern financial markets amplify this dynamic. Asset prices rise faster than wages. Speculation outpaces production. Financial assets detach from underlying value. This creates the illusion of wealth without the cohesion to sustain it. When corrections come, they don't just reset prices, they test belief. Who trusts the system? Who expects protection? Who bears the cost? Ibn Khaldun understood that legitimacy matters more than force. States can compel compliance for a time, but they cannot compel productivity indefinitely. When people no longer believe the system works for them, participation declines, innovation slows, risk-taking collapses. The economy contracts not because resources disappear, but because cooperation does. This is why economic cycles feel so brutal. They aren't just financial adjustments, they are social realignments. Power shifts, old structures weaken, new groups emerge with stronger cohesion and discipline. The cycle resets, not because history wants balance, but because incentives demand it. Importantly, Ibn Khaldun never promised escape. He didn't believe wisdom could freeze systems in their prime. His insight was more unsettling than that. Decline is not a failure of intelligence. It's a consequence of success. The same forces that build wealth eventually undermine the conditions that made it possible. So what does that mean for the individual? Ibn Khaldun wasn't writing personal finance advice, but his framework offers something just as valuable: perspective. Understanding cycles doesn't make you immune to them, but it does change how you interpret them. You stop mistaking peaks for permanence. You stop confusing scale with stability. You recognize when incentives are shifting, even if prices haven't yet followed. This is where real financial freedom quietly begins, not with perfect timing or prediction, but with humility, with the understanding that systems are temporary, confidence is fragile, and cohesion is more valuable than any asset class. You don't need to outrun the cycle. You need to stop being surprised by it. Ibn Khaldun's genius wasn't that he predicted the future. It was that he stripped the future of its mystery. By anchoring economics in human behavior, he made cycles visible. And once something is visible, it loses its power to shock. History doesn't repeat because people are foolish. It repeats because incentives remain stubbornly consistent. Ibn Khaldun saw that clearly long before modern economics gave the cycle names, charts, and equations. His work reminds us that beneath every market, every state, and every financial system lies the same fragile foundation: trust. When trust holds, prosperity follows. When it fractures, decline begins quietly, long before headlines catch up. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.